AP Macro students, and welcome to our AP Masterclass today for AP Macroeconomics. My name, as you recall, Matt Romano, and I'm here with Miss Ray Fields and with our special guest, Dr. Janet Yellen. Now, you probably know Dr. Yellen from her time as the chair of the Federal Reserve Board of Governors, but she's here today to share with us her experience, her lessons learned, and her perspective on macroeconomics. And before any of that, to share a little bit with us about her path to becoming the economist she is today. So thank you, Dr. Yellen, for being with us today. We really do appreciate it. And if you don't mind, just start us off. Tell us a little about your journey, both education-wise, professionally, in economics.
You bet. Happy to be with you all. Well, the high school I attended didn't have an advanced placement program at all. But I was lucky. I took introductory economics during my first year in college, and it was really love at first sight. I'd always liked math and science. I had toyed with the idea when I went to college of majoring in math or chemistry, but then I discovered economics, and I realized it had the type of logical reasoning that I'm attracted to, along with a very practical focus on things that hugely impact the quality of people's lives, like jobs, poverty, healthcare, wages, education, retirement, economic development, a whole range of issues that affect how people live and whether or not they can thrive and feel secure. And there was kind of a personal connection for me too, because my parents grew up during the Great Depression. They told me about joblessness, mass joblessness, and the harm it causes. And my father was a family doctor. And a lot of his patients were blue-collar workers who were affected by the ups and downs in the economy. And he would tell us stories about the problems they faced when they lost jobs and the toll it took on their finances, their health, their relationships. And I think that's part of the reason why I was attracted to macroeconomics, because I discovered that it provides a reason for why market economies can periodically have periods in which there's very high unemployment, and importantly, what policymakers can do about it. So I majored in economics in college. I knew I wanted to pursue it as a career. I went right off to graduate school and earned a PhD. Well, I'd always been interested in economic policy, and I always hoped at some point in my career I'd have a chance to apply the kind of core macro that I'd learned in a policy context. But what most newly minted PhDs do is they take teaching and research jobs, and that's what I did. And I taught at a couple of universities, did research, a lot of it with my spouse, who's also an economist. And our papers largely related to unemployment, what it's like, what causes it, and to macroeconomics more generally. In 1980, I went to the University of California at Berkeley, and I spent most of my academic career there. I was on the faculty of the business school, and I mainly taught economics to students who were going to go on to careers in business and nonprofits. And that actually helped me recognize the relevance of economics, not only to economic policy, but also that it's a really important tool for individuals who are going to go on to business careers. And importantly, I learned a lot from my students. They had lots of real world experience I didn't. And it ended up making me more practical and applied in my own focus. Well, I was happily teaching at Berkeley, and one day the phone rang, and it was someone from the Clinton administration asking me if I would be interested in being a governor of the Federal Reserve. That was 1994, during the early days of the Clinton administration. And I was thrilled and thought, gee, that was a dream job. I went and served. Alan Greenspan was chair. And I learned a ton. I learned about forecasting. I learned about monetary policy. And of course, the Fed does a lot of other things like supervising and regulating banks. I learned about those things too. It took me a couple of years to get the hang of the job. And just when I felt I was getting the hang of it in 1997, I got a call asking me if I would move to the White House to chair the Council of Economic Advisors. And that's a little economic think tank inside the White House. And it gave me the chance to work on a very wide range of issues: Social Security, healthcare, the budget. I spent a huge amount of time on climate change. Al Gore was vice president. You probably know he's very focused on climate change. He wanted the United States to take a lead in this area. And I really didn't know anything about it, but I'm still interested in it and involved in that subject. I think it's critically important. I left Washington in 1999, went back to Berkeley, rejoined the faculty, and then I got an offer I couldn't refuse. And it was to head one of the regional reserve banks that are part of the Federal Reserve System in San Francisco. It was a great job. And then in 2008, we had a devastating financial crisis that I was involved in San Francisco, but President Obama asked me to move to Washington to become vice chair of the Fed, which I did. I worked with Bernanke trying to figure out how we could recover from that. And then I was appointed as chair. And it's really been, for me, a fascinating journey. I absolutely love the field, and I've enjoyed taking the tools of macro and trying to apply them in many different contexts.
Wow, that is a fantastic journey, and thank you so much for that. I'm curious. You mentioned a number of times about how practical the field is, and you took an interest to it, a liking to it, because it affects people's lives. And I'm curious, what have you learned from your opportunities to lead within government? Just what can you pass on to students from what you have learned in those leadership roles?
Well, I guess a couple of things I'd mention as key things I learned. The first thing is, you see when you're in government what an important role government plays in a market economy. If we didn't have appropriate public policy, monetary and fiscal policy designed to promote full employment and low and stable inflation, and regulatory policies that help protect us from financial crises and environmental harms like climate change. If we didn't have good, appropriate, fact-based policies that were put in place, our economy wouldn't perform as well as it normally does, and it would cause great harm to workers and households. So economic policy is important. I think second, I'd mention that what I discovered is the government is a wonderful place to work. It is full of dedicated, smart, energetic people who really want to put their knowledge to work to implement smart policies to make the world a better place. When people ask me sometimes, what is it that I most enjoyed when I was Fed chair? And it's an easy question. I got to work with smart, interesting people, capable, focused on the public good, willing to work hard, and during the financial crisis, give it their absolute all when the country was faced with a crisis. And they work in nonpartisan ways. They're not political, and they are a deep resource that our country has of competent professionals in the government. And I think you can see this in recent weeks. The Fed has mounted a massive and rapid response, and that's because the people there are experienced and know what to do. So I'll say, when I hear people suggest our government is full of waste, fraud, and abuse, I know from my own experience that's not fair, and it's not by and large true. We have a huge talent pool in our government, and it's a wonderful place to work. And I think the last thing I'd say about what I learned is the public really doesn't understand very much about economics. They do not understand much about macroeconomics, and that is a problem. And it sometimes impedes us from implementing policies that would make people better off. It was an especially painful lesson I learned during the financial crisis, when we were doing absolutely everything we could to make sure the Great Recession didn't turn into a Great Depression. But some of the stuff we were doing, it helped Wall Street, it helped banks, and it made people really mad. And that's really understandable, because in many ways, Wall Street was to blame, and ordinary people in the economy were suffering for it. But the truth was that if you didn't rescue America's banks, there would have been no credit flowing into our economy, and households and businesses would have failed in even greater numbers, and it would have been a very bad mistake. So I do think learning about the economy is important, and I wish more people did what you're doing in this AP class, learning core economics.
Thank you. So in your answer, you described connections between your experience working in government, both during the financial crisis, and then sort of connecting it to the current economic situation that we're seeing now. So we've seen you speaking across a number of news programs in recent days, sharing your insights and thoughts on the economy. And we wanted to ask if you could sort of summarize for the students who are watching, what has and is the impact of the coronavirus on the economy right now?
Well, I hate to say this, but the coronavirus has caused an absolutely devastating blow. Just in the last 4 weeks, 22 million workers have filed for unemployment insurance. And if we had a reading today on the unemployment rate, my guess is it's probably running around 15% or higher. And just 2 months ago, the unemployment rate was 3.5%, which was the lowest unemployment rate we've had in 50 years. 2 months ago, almost every firm in America was looking for workers and finding it hard to hire. And now that situation is completely changed. A good aspect of it is that many of the workers have been furloughed by their firms. They're on temporary layoffs. And that means that they still have connections to their jobs. So if business resumes, they're likely to get their jobs back. Another thing is that most past downturns in the economy, including that in 2008 and 2009, resulted from problems in the economy, whether it was a housing bubble that burst, an overinflated stock market, or inflation that had picked up to levels that were too high, necessitating tighter monetary policy. Usually recessions come from problems in the economy. But this downturn is due to an external catastrophe. It has nothing to do with the economy at all. It's like a hurricane or a tornado or a natural disaster, but one that struck our entire country and the entire world. And that means, I think, that if we can get the appropriate public health supports in place so that we can reopen the economy, there's a good chance that unemployment will fall quickly and the economy will normalize without a decade of high unemployment like we had after the financial crisis. I think the chances of recovery being speedy are better the shorter this period of lockdown. I do worry if the lockdown lasts a long time, workers lose connections to their jobs, firms won't have the workers they need when things start up again. Also, household and business finances will be weak if the individuals who are unemployed end up using their savings or take on debt. And that means that when this is over, they'll be tightening their belts when the economy reopens. They'll feel the need to repair their finances, and so it'll depress consumer spending. And I also worry that businesses will fail if they stay shut for too long. They'll be unable to pay their debts. They may go through bankruptcy. And if they survive by taking on debt, then when things resume, they may not be in a position to invest or to hire back as many workers because of that debt overhang. So aggregate demand may be deficient. It may be too low for us to get back to full employment quickly. So I think we need to reopen the economy as quickly as it's safe to do. Once we do so, we may need more fiscal support to generate enough aggregate demand to get us back to full employment. So in the meantime, every public health official that I know says that the preconditions to restart the economy are much greater ability to test than we have now, the ability to isolate individuals who test positive, to do contact tracing. It would be great if at least a treatment were developed that would help limit the damage from the virus, and more PPE and IC intensive care units, beds, and equipment.
Thank you.
Right. Well, thank you. And that, I hear you there. In kind of to piggyback off of that, in the meantime, while the economy is shut down, we've seen a lot of policy action taking place. So in macroeconomics, our students, first and foremost on the monetary policy side, we look a lot about the fundamentals of monetary policy, manipulating interest rates to try to, as you say, even stimulate aggregate demand, hopefully, and meet the demands of the dual mandate. Could you explain to students somewhat how recent monetary policy actions have been implemented and how they intend to maybe not be a stimulus, but at least limit the damage of what's going on right now?
You bet. This is my favorite topic. Well, the Fed has used all the tools of monetary policy that you've learned about in AP Macro to support employment, and inflation's been too low and is falling yet lower. And they also want to move inflation up to their 2% inflation objective. That's the dual mandate of monetary policy. So in early March, the Fed cut its, as they were beginning to see that it might be a serious impact on the US, and that it was impacting China and other countries, they cut their target short-term interest rate by 50 basis points, 0.5%. Then less than 2 weeks later, they cut the short-term interest rate target by 100 basis points, effectively to zero. Technically, their target range is 0 to 25 basis points. Now, there are some foreign central banks who actually, even before this pandemic, had set interest rates at negative levels. That means that you are actually charged. If you're a bank and you have deposited the Fed, you're actually charged a fee to hold money there. But the Fed hasn't and isn't likely to go that far into negative rates, but it is at effectively zero. So beyond that, it's tried to bring down long-term interest rates that it doesn't directly control. For example, the 10-year Treasury bond isn't something the Fed can set directly, but it's also wanted to bring down those longer-term rates that are very important, for example, for people who are going to buy homes. And they went about doing that in two ways. First, they know that long-term rates depend on what market participants think the path of short-term rates will be over a long horizon. Market participants aren't going to accept a very low rate on, say, a 10-year bond if they think that short rates, yeah, they're zero now, but if they're going to rise very quickly and I'm going to invest for 10 years, I'm not willing to accept anything close to zero. But I probably would accept something close to zero on a 10-year investment if I thought short-term rates would stay near zero for 10 years. So first, the Fed has used what's called forward guidance to make clear that short rates will stay low for a very long time, and long rates reflect that understanding. The rate on the 10-year Treasury right now is about 65 basis points, under 1 percentage point, and that's the lowest level we've ever seen in US history. The second thing the Fed is doing to bring long-term interest rates down is to actually go into the market and buy long-term Treasury bonds, like 10-year Treasury bonds. The theory there is that if the Fed reduces the supply of these bonds in the hands of the public by buying them up themselves, the prices of those bonds will rise and their yields will fall. That's sometimes called quantitative easing. We tried that after the 2008 financial crisis, and most research suggests it worked. And the Fed quickly, when this pandemic started, said they would be prepared to buy these bonds in unlimited quantities. And just to give you an example of what they've done, during the week of March 23rd alone, the Fed went out and purchased in 1 week $650 billion worth of treasuries and mortgage-backed securities. And these are open market operations. They expand the reserves of the banking system. They can't put short-term rates down because they're already at zero, but they are succeeding in pushing down longer-term interest rates. That means that mortgage rates and borrowing costs that are linked to those rates are also falling. And that's helpful in stimulating demand in the economy. It'll make it easier, for example, if you have a mortgage, to refinance it, and that'll put money in people's pockets. It'll lower the borrowing costs on many loans that households and businesses have. But there are limits on what lower interest rates can do given the distress in the economy at this point. And then finally, and very importantly, the Fed is doing something else. It is acting as a lender of last resort to financial markets to keep credit flowing and markets operating. When the crisis hit, every investor in the world decided to sell risky assets like stocks and bonds and to flee to cash, because they were scared stiff about losses that would result from the virus. That caused the stock market to tank, and it also caused credit markets to seize up. It's something like an economy-wide bank run. Investors just didn't want to be exposed to the losses they might see on lending to private companies or even to state and local governments. They fled from money market funds that invest in commercial paper, which is something that companies issue to make payroll and to finance inventories. They ran away from corporate bonds and from loans. And what we saw was the borrowing cost, even with treasury yields low, the borrowing costs for loans and invest and borrowers in the economy, including state and local governments, were shooting up. And that threatened the supply of credit to households and businesses. So the Fed has started up massive facilities to support lending. They're buying up corporate bonds. They're selling facilities, setting up facilities where companies can sell commercial paper or newly issued debt. There's a facility to buy municipal debt, and there's a new Main Street lending facility that's starting up to support bank lending to businesses that are too small to issue bonds. There is some possibility of defaults on these loans, and that's a risk the Fed can't take on without having explicit congressional authorization and the taxpayers' support to cover possible losses. And Congress has asked the Fed to take that on. In the CARES Act that was passed a couple of weeks ago, they provided $450 billion to support that lending. And at this point, the Fed's facilities can support $2 trillion of lending in the economy, and it can rise higher. Now, this is a very special role, and in fact, it is actually what the Federal Reserve was established to do in 1913. To serve as a lender of last resort means to step in and lend when others are afraid to do so and are fleeing from doing so. For most of the last 100 years, that kind of support has come by lending to banks through the Fed's discount window when they're experiencing runs. But our financial system has evolved a lot over the last 100 years. And today, to perform that function, it means a much broader set of lending facilities that go way outside the banking system. So that's what the Fed's been up to, and it really amounts to a lot. It's everything the Fed did during the financial crisis of 2008 and more.
Wow. Thank you for that. That's a lot. And I hope our students were listening there, because if you were listening, you heard terms that you are hearing in AP Macro. You heard a lot of, obviously there's much more detail to it than what the textbooks can tell us, but there was open market operations, there was discount window lending, the lender of last resort. Those are all things that AP Macro students are learning and discussing all the time. That's fantastic. If you don't mind, could you, go ahead.
And the reserve requirement, yeah. I think maybe you've also learned about that. They cut that to zero. That was another action that they took. Right,
which is rare. Let's just say, to say the least, rare.
Exactly.
Could you also comment, you've been a part of this as well, the fiscal policy side of things, and what's going on, and maybe what you suspect might go on from here moving forward?
Sure. Well, fiscal policy is really important, and it's absolutely needed to support the incomes of workers and to keep firms afloat during this extremely difficult period. So Congress has actually passed 3 bills, the most important of which is called the CARES Act. That was a couple of weeks ago, and it really provides a lot of support to households and businesses that are being impacted by the crisis. All in all, it's more support than Congress provided to the economy after the 2008 financial crisis. It expands unemployment insurance. The federal government is going to top up normal payments that workers who were laid off would receive. They're going to get it for at least for the next couple of months, an extra $600 per week. They've also made gig workers and those who are self-employed eligible for unemployment insurance. There's a big grant program. It was around $350 billion. Unfortunately, it's run out of money, but it's likely to be topped up in the next couple of days, maybe doubled. That is for small businesses, essentially loans that will turn into grants for workers, for firms that keep on their workers and to help them cover rent and utilities. There are direct checks that have gone out to households, $1,200 for an adult and $500 per child. There was money for hospitals and some money for state and local governments. As I mentioned, there was $450 billion to support the Fed's lending programs. The problem is it really takes a long time to actually get money into the hands of the people and the businesses that need it. There have been a bunch of bureaucratic snafus, unemployment insurance offices in the states. Many of them use antiquated systems. My understanding is that in New York, you have to apply in person, and that's the last thing that's appropriate in circumstances like these. So actually getting the money out, the small business loans, taken much longer to get out than was intended. And so it's an urgent need for the support, and it's getting out there, but it's taking longer than would be ideal. And there is more that needs to be done. Congress, I think, needs to provide much more money for small businesses. I think they'll do that. For food stamps, state and local governments. One of the things you may have learned in macro is that state and local governments, the way they behave usually makes business cycles worse. Because in a business cycle downturn, when unemployment starts to rise, state and local governments find they have to spend more to support people for unemployment insurance, for other support programs. With a weaker economy, their tax revenues fall. They quickly find themselves running budget deficits. And whereas the federal government that experiences the same thing, they can run budget deficits, states, almost all states, are legally required to balance their budget. So in a downturn, what they do is they start slashing payrolls and cutting back on services to balance their budget. And that just makes the downturn worse. So that's happening to all the states at this point, and they desperately need federal money to support them so that they don't make matters worse. They're also, of course, burdened by very high healthcare spending. So the other thing I'd say, Congress has provided maybe enough money for a couple of months. If this lasts longer, more money for support will be required. And as I mentioned previously, I think when the economy restarts and we're getting back to business, more fiscal support may also be needed. There's discussion about a possible infrastructure program that, in my view, the country desperately needs might become appropriate.
So you really talked about a number of different elements that our students should be really familiar with in terms of the different types of policy actions that have been undertaken, some of the challenges associated with implementing those policy actions. These things are going to be really familiar to our students. As you also talked about some additional things that you think we either will be forthcoming or should be forthcoming as we see how this unfolds. As policymakers are monitoring this situation, monitoring the economy, monitoring the needs, what sorts of data or indicators are being monitored, say, on the monetary policy side and the fiscal policy side, in order to determine how much more or what types of additional responses might be merited?
Well, the Federal Reserve looks at every bit of data that's available. And when people used to ask me, when we made monetary policy decisions, what are the most important things? I guess I'd sometimes start in saying, given the dual mandate, inflation and employment or unemployment, but there are many national data series, and we had in the Fed, we had a wide array of contexts throughout the country. The Federal Reserve is set up as, there's a government agency in Washington called the Board of Governors of the Federal Reserve System. And then there are 12 regional banks, and those banks also have branches throughout their reserve districts. And each one of those head offices and branches has a board of directors whose main job really is to inform people in the Federal Reserve what they're seeing happening on the ground in the economy, to bring in information that sometimes can't easily be quantified, but about what they're seeing in their businesses, what the problems are they face, what are the developments in the ground. And the Fed is using all of that. But the truth is that this is happening so fast. So much has happened in the economy in such a short period of time that our national data doesn't capture it.
Mhm.
I mean, the last unemployment rate reading we had was around 4.5%. The day that came out, you could just see from what had happened to unemployment insurance claims. I mean, that was stale information. By that time, the unemployment rate had probably risen a lot higher than that. So all kinds of what's called high frequency data, store traffic, initial claims for unemployment insurance, the kind of data that one gets quickly, credit card data, big data has become prevalent in research, much more available, real-time data that comes out of systems that firms use to monitor the economy. Some of the large banks and credit card companies have daily data on credit card spending that can be very helpful. The Fed has access to a data set like that. And so just a wealth of data, but certainly data on what is happening in the labor market. The little inflation data we have so far, you might think with a decline in supply, this is a supply shock to the economy. You might think that would cause prices to rise, but really the demand shock is so much more important than any supply shock. What we're seeing is that inflation readings have fallen, and I think inflation is going to stay very low. But they look at that wealth of data, and Congress looks at, they look at what's happening in the job market, and they look at what's happening in the states. And they do, I think, a little bit less detailed analysis than the Fed, but they're also supported by the Congressional Budget Office in other analysis.
Thank you.
You bet.
I'm hoping that our students had their mental ADAS model going when Dr. Yellen said the supply shock and the greater demand shock. I hope they saw that in their minds.
I did. Yeah.
Yeah, I
Yep.
did too.
Went right there.
Best tool there is.
Oh yeah, I'm shifting curves in my head the whole time. Yep.
Right. So the students who are watching tonight, they're preparing for their AP Macroeconomics exam. They're on the cusp of their political adulthood. They're maybe a year or two away from voting, being full-fledged members of our body politic. What do you hope they emerge from their macroeconomics education knowing and being able to do?
Yep, thanks. That's a great question. Well, I hope some of you are going to decide that you really love economics and you're going to go on to study some more of it. It's a great college major, and I would promise you that even if you don't go on to become an economist or even major in it in college, that you're going to find it useful if you go into business or in many other fields of endeavor. But what I hope for all of you is that it's going to help you understand the forces that are so powerfully shaping your world. A world that is now impacting, I'm sure, all of you in so many different ways. Some of you probably are going to find yourself doing online studies next year if colleges and universities can't open. It will affect your job opportunities if you're going to be looking for one, at least in the coming year. And I'm sure that many of you have family members who are keenly feeling the effects of what's going on in terms of your jobs and business and health, and understanding what's driving this and the public response, being able to judge it, I think is important in getting through this. You're going to be able to vote and weigh in on public policy, and I hope you're going to use the economics that you've learned to do so sensibly. Look, macroeconomic downturns call for monetary and fiscal policy, and you should understand why that is from the course that you're now completing. I hope you will support sensible policies on the part of the Congress and the Fed, because without public understanding and intelligent support, it isn't actually possible for the Fed to conduct policy. Yes, it's independent. Congress is let it do what it thinks is the right thing. And as I said, it's filled with people who are trying to do the right thing. But if the public thinks it's doing the wrong thing and thinks it's, I mean, and I experienced this pretty keenly. Our crisis interventions after 2008, the financial crisis, for the first couple of years, there were people who said, you are just printing money and it is going to cause runaway hyperinflation. Well, that just didn't show any understanding of the situation at all. And, that could have stopped us from doing what the economy needs. So public support, understanding is really important. And I guess I would hope that throughout your lives, having studied economics, you'll understand that the government and public policy does have a role to play. We have a market economy. We rely on the market economy. There are a lot of good things about the way markets work, but a government that functions, puts in place a good regulatory system and helps when there are downturns in the economy, makes our economy run much more smoothly and effectively. So I hope that you will use what you've learned to be sensible and responsible voters who will help our economy function better.
Thank you.
Thank you so much. That's tremendous advice. I certainly hope the students are writing down, not just listen, write it down, guys. I see that we're coming up on our time. So I just want to go ahead and kind of wrap things up here. I want to thank Dr. Yellen so much for sharing your journey with us, your perspective, your insight. And I just want to repeat what I've told you before, that I know for a lot of our students, you're an inspiration and a role model, and we really appreciate you taking time out of your busy schedule to meet with us in AP Macro.
Thanks so much. It's been a pleasure to be with you, and I wish all of the students good luck in your future careers and studies.
Thank you
Excellent.
so much, Dr. Yellen. Thank you.
Yeah, my pleasure.
Okay. Thank you very much.